Good afternoon and welcome to our discussions on financing decisions. In the last several sessions we saw that the financial statements reflect the financial decisions, or the financing decisions can be seen from the financial statements. One indicator which we have been spending time a lot on, which reflects the financing decision, is the debt equity ratio. But an important question is, what decides this capital structure? What decides this financing structure? Or in other words, what are the determinants of this debt equity ratio? So to understand that, it is not necessary or not sufficient just to see the income statement or a profit and loss account or balance sheet. You have to understand every facet of the business. So the capital structure of a company is a function of several factors. For example, it may be a function of profitability, it may be a function of the size of the business, it may be a function of the growth at which the business is growing, or it may be a function of tangibility. So profitability, size, growth and tangibility are considered to be the drivers of the capital structure decision or financing decision. But what are these? Profitability of a company shows the ability to generate and ability to distribute profit among the shareholder. But to test the capital structure and profitability, it is better to take profit generating ability, that is PBIT, and capital employed. Then the size. Size has a huge impact on the capital structure. Several researchers have shown that. So what is the size? Size of the business means the size of the assets, or it is the size of the turnover. Any of these indicators can be taken. The other one is a growth. The growth is a rate at which the company is growing. That means again the growth of the sales or the growth of the assets of the company. And the last one is the tangibility of the asset. What is this tangibility? The tangibility is the amount of the fixed assets in the total assets. For example, we all know that an IT company almost all over the world, the debt equity ratio is less than 1. But that may not be the case with a non-IT company, a core sector like Tata Steel or Steel Authority or Mahindra, because they have significant amount of fixed assets sitting on the balance sheet. So tangibility can be computed or determined by fixed assets to total assets. So that means the capital structure of a company is a function of profit after tax or profit before tax, that is a profitability, is a function of the size of the business, is a function of the growth at which the business grows, either sales or the assets, or is a function of the tangibility. So if you put it in the form of an equation, I will say that the debt equity ratio is a function of PBIT by capital employed, the total assets, the rate at which the assets are growing or sales are growing, and the fixed assets to total assets. But to answer this question, maybe one has to understand a regress, take the help of a regression and check over a period of time what is determining the capital structure. And we will see one by one in some of our future sessions. Thank you very much.